Hello and welcome to this YouTube channel for ACCA FR exam prep. My name is Eden. In this video, I will be taking you through how to account for current tax or current tax provision and the deferred tax movement. So let's look at the details of this question. Now, this is an extract from a full single entity question. So I'll take you through the details. After preparing a draft statement of profit or loss for the year ended 30th September 2014 and adding the year's profit, which is before any adjustment, to note 1 to 3 below to retain earnings, the summarized trial balance for Candy is as follows. So this is the trial balance, and you know this is debit, this is credit. Now, on the face of the trial balance, we have deferred tax. And once it's credit here, you should know that this is a deferred tax liability. And it's a very important exam technique to note. Now, we have current tax. Now, the current tax is appearing under the credit side of the trial balance. That indicates over provision from the prior year. Now, if it were on the debit side of the trial balance, that is under provision from prior year. So if we have over provision, the impact of over provision of tax expense from prior year is that it reduces the current year tax expense. Very important. Now, let's look at the notes. The price of property has increased significantly in recent years, and on 1st October 2013, the directors decided to revalue the land and buildings. Now, let me make the point that the land and building on this date, which is the 1st of October 2013, from the original question, the land component was 5 million, and the land and building, so the land and building on the face of the trial balance was 35 million. So straight away you should know that the building component is 20 million. And on that same trial balance, we have accumulated depreciation on the building, which this is debit, this is credit, which was 20 million. So here the land component 5, the building will be 30 million. So 5 from 35. Okay, so this is just additional information to take note of as we deal with the details of the note 2. Now, let's accepted the report of an independent surveyor who valued the land 8 million, the building 39. On that date, the remaining life of the building at 1st October 2013 was 15 years, and that will be for depreciation. Candy does not make an annual transfer to retain earnings to reflect the realization of the revaluation gain, and this we have covered in one of our earlier videos on this channel. Now, however, the revaluation will give rise to a deferred tax. So this is the focus of this question. It will give rise to a deferred tax liability, and the income tax is at 20%. So we have to find the gain or the revaluation surplus on this land and building, and we have to account for the deferred tax on this revaluation surplus. Now, the note 3. A provision of 2.4 million is required for current income tax. So this is the provision for the current year. The balance on the current tax in the trial balance is under or over provision, and this is how it will always be given, under or over provision. You will not be told it's under, you will not be told it's over, but with a good exam technique like I have indicated here, if it is on the credit side, this is over provision. If it is on the debit side, that is under provision. Please take note. Now, in addition to the temporal difference relating to the information note 2, Candy has further temporary, which is taxable temporal difference of 10 million. So how do we put all of these together? So in terms of our workings, so if we were to have, let's say this is our extract. So our extract, we have the P&L and we have the statement of financial position. So, and I'll have my workings beneath this one. So I have my workings here. And I'll say all figures in thousands of dollars. So what I'll do is, if this is my workings 1, I want to look at the non-current asset schedule. And the reason I'll do this is to find a gain. So the schedule will give me the land, will give me the building. So what I'll do here is to bring the land and the building at their cost. So cost at 1st October 2013, the land was 5, the building will be 30, so that the total would give you 35. And we had accumulated depreciation, which I gave to be 20. So the carrying amount, of course, the land is not depreciated. So the carrying amount as at 1st October 2013 for the land is 5, for the building is 10. Now the revaluation, so we leave a line in between and say the revalued amount. For the land, it was given the question as 8 and the building was 39. So the reason we are doing this is to find the surplus. So you have the revaluation surplus. This should be 3 and this should be 29, and that gives you a total of 32. Now, the reason I've taken you through this is for us to find the temporal difference. So this will be the temporal difference, arising from the revaluation, and this would attract a tax at 20%. Now, the next thing I want to do is to look at my tax movement. So my workings 2, I can call it income tax. And here I want to share with you very significant exam technique. So what I'll do is to say current and then have by the side deferred. So I'll bring the opening balances. So I'll say balance brought forward. And on the face of the account, which is the trial balance we are given, the balance brought forward on the current tax is 1.1, and that of the deferred tax is 2.5. So I'll bring that in here quickly. So this is 1.1, and then under the brought forward is 2.5. Please take note. What I will do next under the current tax is to add the current tax provision. So I'll say current tax provision. Remember, this balance brought forward is over. It was 2.4. So I'll bring the 2.4 here. So I'll say 2,400. The remaining adjustment which would affect the current tax should come from the deferred tax movement. I take that again. The remaining adjustment which would affect the current tax expense should come from the deferred tax movement. So I go on to my deferred tax movement, and this is what I'll do. I'll leave 2 lines, and come here and say the balance. And there are two things I'll look out for: the temporal difference arising on the revaluation, which is 32 million, and that will be 32,000, plus the other temporal difference we were given in the notes. So here, the further temporal difference of 10 together will give us the total balance on the deferred tax at the end of the year. So the 10,000. All of these two at 20%. So now I can have, let me just shift this a bit. Let me shift this a bit to the other side. So I can now have the closing balance. So the closing balance, that will be 42,000. 42,000, we got 32 plus 10 times 0.2. So 42,000 times 0.2. That gives us 8,400. 8,400. Now, in this 8,400, a portion of which will not go to P&L because it will go to OCI, because the revaluation gain would go to OCI, and therefore the related deferred tax should also pass through OCI. So I'll scoop that out of this total so that I can actually know the movement in deferred tax that will go to P&L. So I'll say revaluation tax, and that should be based on the 32,000 only. So the 32,000 only, the revaluation tax on it. So 32,000 times 0.2, that gives me 6,400. And this was supposed to increase the balance. So it means that the actual movement in the deferred tax year, which will go to P&L, I'll look at this. It is the 8,400 minus the 6,400. So look at it. When you take this from this, you have 2,000 actually remaining, minus the actual opening balance. So this 2 minus 64 minus 2,500, which is the opening balance. Now what this will give you is that we had a decrease in provision. So I'll put here decrease because I have negative here. So you have, this will be equal to negative 500, and that is a decrease in deferred. So I'll say DFT tax, and that should be, so look at it, this 25 plus negative 500 plus 64 should give us the closing balance. So I will now transfer the movement in deferred tax which affects P&L to the face of the current tax movement. So I'll say decrease in deferred tax, and that is 500, and the decrease is a deduction here. So I'll have the net. So look at it, it's 2,400 minus 1,100 minus 500. This will give us 800, and this will be the tax, the current tax expense. So to look at the details that will go to the financial statement, please take note. Very easy. This would go to the financial position as current liability, which represents the current tax provision. Now this will go to P&L as the expense for the year in terms of tax. Then the balance on the deferred tax would also go to the financial position as non-current liability. To illustrate these on the face of the financial position extract I have above here, I would say that tax expense. So let's say this is my workings 1, and it's 800. It's an expense, so therefore you deduct from profit. Then on the face of the financial position, I'll say non-current liability. and that is workings 2, and that figure we had was 8,400. And under the current liability, I'll have what we call current tax payable, and that was given in the question to be 2,400, or as well you can make reference to workings 1. So very important exam technique. I hope that these illustrations would go a long way to help you understand how we account for the deferred tax and current tax, and how we present this movement on the face of the financial statement. Please subscribe to this channel to receive updates on new videos.